You know, every time I go to one of these, I tell everybody that comes, come expecting. Come expecting to meet someone that you're like, that you share solid fundamentals, solid values with. Right now, we're talking about finance, the fundamentals of finance. But I also say, expect to have something change in your life. Walk away excited, fired up, ready to rock and roll. And I gotta be honest with you, I was super pumped. There was obviously some mistakes. I didn't get to speak, but what I wanted to say, and this ties in with my relationship with Joe, is we are literally experiencing a war, a financial war between good and evil. You have God's money and you got Satan's money. It's written all over the dollar bill. And we all know that debt leads to death, and it keeps us only a sliver of what we are capable of. When I met Joe, he had shared with me his life's ambitions, his dreams, his goals, and they lined up with mine perfectly. And I knew that day, and I told him that day, that we were gonna do great things together, and it has been absolutely amazing to get to know him. So if you guys wouldn't mind raising your hands and giving a round of applause to Joe Brown of Heresy Financial, I'd really appreciate it. It's not bad.
All right. How many of us would like to know the next global reserve currency? I've got good news for you because there are only 4 potential options. So we are going to talk about which ones are most likely, which ones would be great, which ones would be terrible. But before we do that, we have to take a trip back in time about 3,000 years ago and understand what got us to where we're at today. Because just like in Alice in Wonderland, if you don't know where you're going, any road will get you there. And so we have to go back and see what got us here so that we know where that momentum is taking us. So we are going to go back 3,000 years in history to take a brief, like a rocket ship, through the history of different monetary systems to understand where we're going next. My name is Joe Brown. I run Heresy Financial. I've been making YouTube videos for about 3 years now, educating people about how money works, because I firmly believe that if more people understood how money works, more people would be able to make more wealth and keep more of it, and therefore give more wealth, and the world would be a much better place as a result. So let's start off 3,000 years ago when gold was money. Now, we need to make a distinction here because this is not gold-backed money. This is not a gold exchange standard. This is not a gold standard. This is gold as money. So think Roman times. You have gold, silver, copper coins that you use to transact with. You give them a gold coin, they give you a sandwich. So this is how the world worked for a very long time. You have actual coins trading as money. In this type of a monetary system, it is a fixed supply. So why is it a fixed supply? Well, because as we all know here, there are only 2 ways to get gold coins, gold bars, to get gold. One of them is to do what many people here are doing, which is go and dig it out of the ground. But that takes money, that takes time, that takes labor, that takes capital, that takes resources. So if it takes $1,000 to get an ounce of gold out of the ground and you can only sell it for $900, you're not gonna pull gold out of the ground. You're just gonna go buy it on the open market. And so the other way to get gold is to give somebody something that they want enough to pay you money for it. So under a fixed supply gold standard, the only way to increase your wealth is to create something that somebody else wants badly enough to pay you for it. Wouldn't that be a great world if we lived in today that there was no ability for anybody to take wealth from you unless they gave you something you wanted more than that wealth? That's how the world operated for most of human history, and that is the monetary system under which humanity thrives the best and wealth grows at the fastest pace. The reason for this is largely due to debt. So when we look at how debt works in a fixed monetary supply, we have to understand the opposite of inflation, which is deflation. If we start off and we're hunting for all of our food, we spend all of our day looking for one meal. We invent a technology called farming, and then we bring those animals to us, and now we don't have to spend all of our day looking for one meal. We have our meal waiting for us, and we can spend our day doing something else to provide something for ourselves that we want. Further than that, we invent using animals for farming, and now we don't have to spend our own labor farming and getting more food. We use the animals. And then we figure out we can do machines to do our labor for us. And so we don't have to use animals anymore, and we can have a field that produces food that it used to take hundreds of people, and now it takes one person and one machine to produce the same amount of food. All my labor, all my time, all my capital, all my resources can go to doing other things that are more productive as a result. And so we have thousands of years of deflation because we have an abundance of stuff. The stuff grows faster than the money supply grows. Because if I want more money, I have to go dig it out of the ground. So the money supply doesn't grow. But the stuff grows. And so as the stuff grows, it takes less money to get more stuff. That's deflation, and that's an increase in real wealth. So we go to the period of time in, let's say, 1860 through 1910, when there was no central bank. This was a period of deflation pretty much every single year, definitely every decade, where the wages nominally dropped every single year. So how many people would like it if you got a pay cut every single year? All right, well, how about this? You get a 10% pay cut, but your cost of living drops by 15%. Now how many want to sign up for that? Everybody does, because your wealth increases. Even if the number doesn't go up, you're getting richer, you're getting more abundance. That's how the world has operated for thousands of years. And it comes back to debt. Because with debt, you owe somebody money. You borrow money from somebody, and then you owe it back to them. And if you borrow money from somebody under a deflationary monetary system, money gets harder to get because wealth grows. So if I borrow $1 from you, and $1 is equal to a potato, I have to get a potato to be able to pay you back your $1. But in 10 years, that $1 might be worth 10 potatoes. So if I try and give you that $1 back in 10 years, I need to go get 10 potatoes to give you that $1 back. So debt is punished long-term in a deflationary monetary system because money becomes more valuable relative to all the stuff over time. So our grandparents' wisdom, our great-grandparents' wisdom about save, don't get into debt, that used to be true for most of human history because savings became more valuable over time as the wealth grew and the money became more valuable relative to all the stuff because we had more and more abundance. And so debt was punished, so people saved. And you cannot increase the wealth on aggregate in a system unless it's done through savings, because you have to save to invest and to buy things and hold back your purchasing power to build up reserves to invest in something that's going to produce more value long term. So if you don't have savings and you only have debt, you're only going to start destroying wealth. This means that interest rates are a signal about the abundance of the money supply. So when we go through, when we look at interest rates today, we see, okay, interest rates are low still. That would mean in a free market that money is abundant. There are so many people with so much money that they're competing for borrowers. So lower interest rates are a signal that money is abundant, so go out and take risks and borrow. In the opposite, when interest rates are high, that's signaling that money is scarce. Because you have a scarcity of money, the borrowers are competing for lenders, so the lenders can charge a very high interest rate. Throughout most of human history, when the money supply is fixed, that happens naturally as people spend money and then people save money. The price of money, the interest rates, adjust for what the economy needs. So you don't get these booms, you don't get these busts, you have people making their own individual decisions because the money supply is fixed and people are able to make educated decisions on their own. Now, if we fast forward here, we're going to go to the invention of the banks. You get to a point where your gold coin is no longer has a low enough value to go and buy groceries with it. You can't just go buy a sandwich with 1 ounce coin anymore. That's worth a down payment on a house. That's worth a horse. So I'm not carrying that around in my pocket with me anymore. I'm going to have to put that somewhere safe. So I'm going to give it to somebody who's going to pay me, or I'm going to pay them, I should say, to store that for me. And they're going to give me a little paper note that says, hey, I can come get that back from you at any time. This was a bank note. This says redeemable to the bearer on demand, $5 in gold coin to the bearer. So what that allows me to do then is I can take that, I can give that to somebody else instead of going and getting my gold coin and then giving my gold coin for a horse, and then he takes that gold coin that I just gave him for that horse and he goes back to the bank and gives them the gold coin and gets another piece of paper. I'm just gonna take that piece of paper and I'm gonna give him the piece of paper for the horse. Well, the banker then realizes, hey, I've got an opportunity to make money here. I'm operating a savings business. Now I'm gonna transition and also operate a loan business. So before this point, it's important to recognize no change has taken place with the money supply. There were, let's say, 10 pieces of gold trading before. Now there's 10 pieces of paper trading. No inflation, no fraud. It's perfectly fine. But as soon as the banker decides, I'm going to loan money into existence, we have a problem. Because he says, hey, I'm going to lend somebody money. Before this, if I wanted to borrow money, little Johnny has to go to Aunt Sally and take her money. So the money supply doesn't increase with debt under a fixed money supply. You're just borrowing money from somebody else. But what the banker does, the banker says, hey, somebody wants to come borrow money from me. So you go to the banker, he writes you one of these notes. Now there's not an extra piece of gold in his vault to back that up, but he still gives you one of these notes so that you can go out and spend it. So now instead of 10 pieces of money trading like there were before, now there's 11 pieces of money trading. Now suddenly for the first time you have inflation because you have more money chasing the same amount of goods and services. You're not increasing the wealth, you're just increasing the claims on the existing wealth. So you have a wealth effect where people feel richer, so they say, hey, times are growing. We've got a lender who's offering loans at low interest rates. So I'm going to go out, I'm going to get more debt, I'm going to spend that because I'm going to make more money, and you have a boom for the first time. You have a boom that's built on an expansion of the money supply based on an artificial expansion of credit. Well, what this does to the economy then is it creates this false wealth effect and risk, because this is ultimately destined to unwind. Why? It's built on debt. What does debt have to be done to? It has to be paid back, or it gets defaulted on. And so at some point, the debt issuance slows down or stops, and then prices stop going up. Are you gonna hold on or buy a stock if you know it's not gonna go up? No, you buy stock so that it will go up. If it's not gonna go up, what are you gonna do to it? You're gonna sell it. And so when you sell it, then that prompts the price to start going down. So once the boom tapers off from the money supply expansion stopping, prices then start to collapse. Well, when prices start to collapse, you start to save more, you start to hoard more, you start to pull in, you start to spend less. That means other people have less income. Because you have less expenses, you start to pay off your debt because it's getting more expensive. Everybody starts getting scared. You go to the bank, you give them your piece of paper, no gold. So now you have a bank run. So we have the invention of banks followed by the invention of the local boom and bust, followed by bank runs. We've seen this happen over and over and over throughout history. This is a picture of a bank run happening during the Great Depression. Now, what the governments should have done at this time was outlaw this practice, right? This is fraud. Every single one of those notes says payable to the bearer on demand in $5 worth of gold coin. So if I go there and try and get it and they don't give it to me, that's fraud. It should have been outlawed. But they said, no. It's not because of the fraud. It's because of the scale. We weren't doing it big enough. So we need to invent something called a central bank. We're going to fast forward here. This is a painting of the Bank of England, one of the first central banks, modern day central banks. So they said, we need a bank for the banks so that if there's a bank run, they can just pull money from the rest of the financial system and bail out that local bank that lent too much. So they centralized this, they scaled it up. But an iron law about risk is that you cannot eliminate risk, you can only transfer it. When you get life insurance, have you eliminated your risk of dying? No, you've transferred that risk to the life insurance company. When you get fire insurance, you didn't eliminate the risk of getting a fire, you just transfer that risk to the insurance company. So you can't eliminate risk, you can only transfer it. And so when you transfer risk from a local individual node in a system, you transfer it to the entire system. Now that makes each individual less susceptible to failure, but it makes the entire system now susceptible to failure. If I'm on the edge of a cliff right here, and I'm about to fall off, let's say I do fall off, and there's a bunch of people behind me, what is everybody gonna do? They're all gonna back away from the cliff, because they don't wanna fall off. Everybody has an individual risk of falling. Now let's say we put a railing up. Everybody, kids, starts hanging on, looking over the edge. Suddenly the railing's not strong enough and everybody falls. So when you eliminate the risk of individual failure, you transfer the risk to the entire system failing all at once. And that's exactly what happened with the invention of the central bank. When we centralized and we paid for wars, caused hyperinflation. These are not blocks of wood that kids are playing with. These are stacks of money in Germany during the Weimar Republic, hyperinflation. So we transferred all that risk to the entire system in countries as we scaled up that fraud of fractional reserve banking. But that still wasn't enough, because we all know what happened in the 40s with Bretton Woods when all of the monetary systems around the world from central banking had failed. They didn't say we shouldn't have done this. They didn't say the problem was the fraud. They said the problem was we weren't doing it big enough. We have to globalize now instead of just nationalizing this. So what do? They met at Bretton Woods in 1945, and they all pegged their currencies to the dollar because the United States still had gold. And so the Federal Reserve became the central bank to the central banks, which were central banks for their own banks. So they scaled up the risk, they scaled up the fraud, and America had a few decades of spending money, and we all know how that ended. It ended with a bank run just like it always did. People decided, they looked around, they said there's too many pieces of paper floating around. I'm gonna go turn in my money for real wealth. And there was not enough real gold in the vaults to back that up. Since then, we've been on a fiat standard, the first time in history where we've been on a fiat standard for the last 50 years here, where there's been no anchor to how much money can be printed. We've seen an unlimited amount of printing by many governments, more episodes of hyperinflation than we've had through all of human history since 1971. This is a picture of Zimbabwe where he's going to buy a loaf of bread at the grocery store with a wheelbarrow of cash. In these situations, you walk up with your wheelbarrow of cash because you saw the price an hour ago and you know you need one wheelbarrow full of cash. So you get there and they say, oh, sorry, 10 minutes ago prices went up. You now need 2 wheelbarrows full of cash. But guess what? ATMs and bank limits are tapped out. You can't get another wheelbarrow of cash today. Now, it's not going to happen like that ever again because it's just going to be digital. So you go to swipe your debit card, you've got a daily limit of 100,000, 200,000, whatever. But if the price goes up right before you swipe, it doesn't matter if you have $1 billion in your bank account, you can't swipe more than $200,000 a day. Your groceries cost $300,000. You can't buy groceries that day. That's what hyperinflation looks like in the digital world. And so as a result of this, we have an unlimited amount of spending, which means an unlimited amount of power for governments, but ultimately this is destined for failure. And we see this all around us today when we look at the Cantillon effect, when we look at people who are able to spend the money before everybody else gets it. When we look at the politicians and the organizations and the corporations that are able to get the bailout money first, they spend it on assets, then they spend it on the cheap stuff. Then as that money works its way throughout the economy and bids prices up, everybody else has to pay the higher prices, and then they are able to sell their assets at the top once the Federal Reserve sells all their stocks and starts to tighten. And so we get into this situation where we're asking the question, what comes next? Because we know this is doomed for failure. Every fiat currency throughout history has failed, gone to zero, and every fiat currency that's in existence today is down 95 to 99% from its inception. So it's only a matter of time before it goes that last 1% to 5%. So the question is, what's next? We know that in the past we've had commodity money, which was gold coins. We know we've had commodity-backed money, which was fractional reserve banking, banknotes backed by gold. We also have had in the past ledger money, public ledger money, which today is like Bitcoin. In the past, there were rhinestones that were verbally and mentally owned by tribes on the Micronesian islands. This is ledger money. It's an archaic version of Bitcoin. And we also know that it's possible that we have a private ledger money, which is a central bank digital currency. Those are the only 4 options about where we go in the future. Now, you might say, okay, well, what about this fiat system? How does this continue? What if this keeps on going? And the answer is, well, the next evolution of that is a central bank digital currency, because every fiat currency eventually fails because, as we saw through the last 3,000 years, this system is built on a foundation of fractional reserve banking, which is built on debt, which is built on rules from a gold exchange standard, which is left over from a gold standard. And so we have this archaic system of rules and ways things are done that make it difficult for central planners to centrally plan. And so when fiat currencies eventually go to zero, they're not going to say, we've screwed up, we should just let people choose their own money. They're going to say what they've always said: we didn't do it big enough. It failed not because we controlled it and made a mistake, it failed because we didn't have enough control of it. So they're going to roll out a central bank digital currency, a private ledger money. So let me take a step back and explain what a ledger is. It's just a list. I use the example of a billboard, magic billboard that everybody in the world can see, or an example of an Excel spreadsheet. Everybody knows an Excel spreadsheet. You can send a link to somebody. Anybody can view it if you invite them to it. An Excel spreadsheet that just has on every single cell, this person owns this much of this Excel spreadsheet. This person owns this much. And I can go to anybody and I can say, who else wants to own the spreadsheet with me? You can give me $5 and then I'll write on the next line of the spreadsheet, John owns 50% and I own 50%. And it came from me for $5. And go on and on and on and on down the list, and everybody can see it. And there's no way to steal money from that because everybody's looking at it. And so if somebody tries to hack in and change their amount of the Excel spreadsheet that they own, you're just going to look at that and you're going to say, no, we all saw you change it back. And if you don't change it back, you're going to say, well, where did you get that money from? There's no paper trail. We can see the whole paper trail here. That's a public ledger. That's Bitcoin. There's also a private ledger, which is a CBDC, and it's the same thing, but it's not made public. There's just the Fed. There's just the central bank. There's just the Bank of England that can see that list and can control it. Now, this is the way that many governments are going to try and go, because it allows them to scale up the control, and it allows pure control over the flow of all resources in an economy. If I think that there is a problem with gas prices as a central planner, I can say that the reason for that is because you were hoarding gas. So I'm going to make a new rule that if you go to the gas station and spend more than $400, you're cut off for the month. And I can do that without any legislation, without any bureaucracy, without any regulations. I can do that without any worrying about getting voted back into office. I can do that at a click of a button because I control every single person's bank account. I can also say, hey, we don't have enough money going into green technology, so we are going to give everybody $1,000, but it can only be transferred or spent to other accounts that are businesses operating in green technology. Oh, and by the way, if I want to stimulate the economy, I can give everybody $2,000, but I don't want to cause a bubble in the stock market, so I'm not going to allow it to be spent on stocks. I'm not going to allow it to be spent on Bitcoin. I can say, hey, people are becoming too violent and posing a threat to their neighbors, so we're going to stop the transactions of certain forms of ammunition for a while. Whatever they want to do, they can do without any legislation, without any risk of being voted out of office. You control the flow of resources and capital in the economy if you control the money. Mayor Amschel Rothschild said, give me control of a nation's money, and I care not who writes the laws. That's how powerful the control of money is. So that's one option. We see China is experimenting with it. We see the United States is talking about it. We see about 11 countries experimenting with it right now. That is one option where the world will try and go with the monetary system next. Another option is commodity money. Gold coin, silver coin as money again. Now, I think that gold and silver and many other metals I am extremely bullish on for a long time here. However, I do not think that they'll return to be used as money unless we have nuclear fallout and all technology is destroyed. Because we live in a globalized society, even though we're going through deglobalization, we live in this technological world, and if I have to pay security to transfer my gold bar to China to buy something from there, it's not going to happen. Now, a gold or commodity-backed money is very possible because I don't have to ship my gold somewhere to buy something. It's stored in a third-party vault like it always has been, and I own gold in that vault. And so when I pay you for a service halfway around the world, I just transfer the ownership of that gold bar to you, just like commodity-backed money has always worked. We also see central banks moving towards this right now. For decades, since 1999, central banks on net have been net buyers of gold, stocking up gold in their vaults. They've been stockpiling it as they've been printing fiat currency, telling all their citizens to use this paper. They've been using it to buy gold. And so we see a lot of central banks storing it up for themselves. And then we see countries like China, Russia, India, South Africa, Egypt, Turkey, talking about developing a new global reserve currency that is backed by commodities, backed by energy, backed by gold, backed by oil, backed by something that nobody can control. Because the world has gone through decades of the United States controlling the flow of resources around the world because they control the dollar. And a lot of countries are fed up with this right now. So option number one is CBDC. Option number two is commodity money, which probably won't happen unless all technology is wiped out. Option number three is commodity-backed money, which many countries are also trying to move towards. And then option number four is public ledger. We've seen El Salvador move to a Bitcoin standard themselves. That is a possibility as well. Now, I would like to suggest for the last couple minutes here that I'm up here, that the two most likely options are commodity-backed money and a central bank digital currency. One of these is going to be very, very good for the world and for any country that adopts this system. And one of these systems is going to be very, very bad for anybody who adopts this system. Because when you have complete control of the flow of resources in an economy, you destroy it. There are three things necessary to centrally plan with totalitarian control. There are three things necessary to do it correctly. Number one, you need perfect power, perfect control. Number two, you need perfect information so you don't make a mistake. And number three, you need perfect morality so that you don't abuse it and cause destruction. We know that all three of those are impossible for a central planner, so it's doomed to fail. But it can take a while before it fails. And you might be asking why somebody would ever sign up to use a CBDC. And the answer is because we're heading into a deflationary deleveraging right now. We are heading into a time when the Fed is tightening, we're experiencing a recession, prices are starting to fall, we're experiencing more and more fear, worse and worse consumer sentiment, we could experience bankruptcies, layoffs, unemployment, people all over the place losing their jobs, and when things get toughest, the central bank is going to come out and say, we have the solution. All we have to do is give you $2,000 every single month. Every individual who wants it can get $2,000 a month. But the IRS can't handle it like they tried to with the stimulus checks during COVID. They're not going to be able to support that. And also, we want to avoid all the problems as a result of last time. We as a central bank, we don't want to cause any more stock market bubbles. We don't want to cause any crypto bubbles. We don't want to cause any shortages of toilet paper. So we are going to do this through a currency that we can control more, a CBDC. And as long as you sign up, you get your $2,000 a month. Now, yes, there will be restrictions. You can't buy your stocks, you can't buy gold, you can't buy Bitcoin, you can't buy more than 10 rolls of toilet paper a month or whatever it is. We're going to control those things, but it's for your own good. And guess what? You're all so much in pain. You're struggling so much that you're saying, what choice do I have? And I'm not talking about us who know what's going on and are paying attention. I'm talking about everyday Americans who are looking at this and saying, I don't have an option. I'm going to have to take the handout, even though it comes with a handcuff. And they're going to take the CBDC and they're going to be enslaved to the new monetary system, and you're not going to be able to escape it with any wealth that you have inside of it. And so on the flip side of that, I highly advocate storing wealth outside the system right now while we can, because you can use your fiat currency to buy gold. You can use your fiat currency to buy silver. You can use your fiat currency to buy Bitcoin and whatever cryptocurrency you want and store food in your backyard and buy water filters and anything you want right now. But when it hits the fan and they control all the flow of all the money, you might not be able to get out. And so I highly advocate creating your own commodity-backed standard, commodity money standard, your own private ledger standard, your own money standard, so that you don't have to be vulnerable to the risk that they've transferred from all individuals to the entire system. You can escape the system by getting some of the wealth out of it beforehand and not be vulnerable to the tyranny that will come into play for anybody who's been closing their eyes. So that's what I would advocate, and thank you so much for your time. I think we have 5 minutes if there are any questions. Question is, what about a precious metal-backed crypto? I think there is a lot of practicality in those tools. I have not ever seen one yet, there's a couple of them, that have provided more utility than splitting them up. So what I mean by that is if gold or silver is the money or the asset, the addition of a blockchain on top of it doesn't add any value. The only thing it does is allows you to see the transactions that have taken place, but you still have the trust necessary to make sure that the gold is there and actually being transferred along with what the blockchain is saying. And so you get back to the original problem with gold storage, silver storage, which is you need to make sure you can trust your counterparty. You need to make sure it's audited, it's insured, it's segregated, it's allocated, all the things you have to do anyway. The blockchain doesn't solve any of that. It just makes it more expensive and a little bit less efficient. On the other side, if the cryptocurrency itself is the asset, I don't need the cost of storing a physical asset underneath it. It's the cryptocurrency that's the asset. So I like Bitcoin. I know lots of people like other cryptocurrencies for different timeframes and different uses, but if the cryptocurrency is the asset, let it be the asset. If the commodity is the asset, let it be the asset. I haven't seen any increased utility in combining them to date. Okay, so the question is how long until CBDC is implemented? It's a guess, right? But we already know that China and about 11 other countries are experimenting with it. We know that the Federal Reserve is actively researching it. And so we know that there are many places that are getting it ready in their back pocket. And so in my opinion, it depends on the speed of the collapse and the amount of pain. Because if the Fed today came out with a CBDC, how many people do you think would sign up for it? Zero. Nobody's in enough pain yet to accept that, to trade their freedom for that. And so it depends on the extent of the pain. So if they really want to roll it out, you're going to be watching for like depression level economic pain. So that's my opinion. If they keep on going the way they're going, it could happen within the next couple of years. Great question. Could we have a split monetary system? And I should have said this, so thank you. My anticipation is that the failure of the fiat system will result in sprouting of multiple competing monetary systems. And so the BRICS countries will launch a currency for international trade backed by a basket of commodities. America, the UK, other countries will launch their own CBDCs with rails to have international payments be quick and efficient and secure. We're gonna have other countries that just say, no, all Bitcoin. I think we're going to have competing monetary systems all around the world, but money is a winner-take-all game. That's why gold was king for thousands of years. That's why the dollar, despite all of its flaws, has been king for 50 years, because money is a winner-take-all game. And so one of them will win. We just don't know which one, but for a while they will be competing. I'm out of time here. Thank you guys so much. I'll be here the rest of the day. Thank you for having me. God bless.